taking a fair market value, but we can take we can transfer it at our AC. Yeah.
Just if I take it
Equal fair market value.
I don't care. No, I don't think I'm gonna get hired by anyone.
Say we have one of these bad paid up capital situations. So there are,
Science business school.
You're giving up an asset on the fair market value for consideration for.
we have two shareholders. One is aggrieved, disgruntled, because the paid up capital of her shares is less than her adjusted cost base. So she bought shares of the company. The shares were originally issued to somebody else, and she paid more than the paid up capital of the shares. So if she were selling the shares, she'd be happy because she got a high adjusted cost base. But the company just let the shareholders know that the company's about to wind up, which means that all the shares will be redeemed and that whatever cash in the company will be paid out to the shareholders, and it's a big amount. So this person is sitting on a really large deemed dividend. Ooh, bad. And you, however, have a solution. The solution is simply for her to use a Section 85 rollover to put her shares of the company, which she owned directly, into a corporation, new corporation, owned by her, let's say 100%. So then what happens is that this company redeems these shares and pays cash up to here, and there is a deemed dividend up to this company rather than to her personally. Thus, the only thing that this company might have to worry about is Part 4 tax if, and let's say these companies are all connected. This company is connected with this one, maybe it's a 50-50 situation. This is also, sorry, there is no connection here because connection is not with an individual, it's only corporation. So as long as there's no RDTOH down here, thus no dividend refund here, there's no tax to pay by this company. So her share of the cash is now up here, and she has paid no personal tax in this situation. And she can defer paying tax as long as she wants. She doesn't have to pay tax until she actually wants to take the money out of her corporation. So that's one way by which we can fix this issue by which our paid up capital is lower than we would prefer it to be. Any questions on that?
That's not dodging any tax. That's just,
Not at all.
That's just deferred.
Straight planning. Straight planning and straight deferring. The tax will be payable someday, but she gets to control when she wants that.
Could that intermediate corporation take that dividend and reinvest it in something else that could generate different kinds of gains rather than issuing her a dividend and completely just change the value?
Oh yes, so what this company has now is a whack of cash. It can do whatever it wants to with that cash. Invest it somehow, buy another operating company, loan money to somebody, buy an apartment building. The role of lawyers in a Section 85 rollover transaction is, first of all, there's a transfer of property. So an agreement has to be prepared for purchase and sale of whatever it is that's being transferred. And given that it's a related party transaction, if it is, that is a transaction where the transferor is related to the transferee because it controls the transferee, or it's related to people who controls the transferee. So Section 69 has to be respected. The total consideration has to be equal to the fair market value of the transferred property. So there's that agreement to be filed. There's also the election form, you recall I spoke about this prescribed form referred to in 85-1. That has to be filed. That's usually filed by the accountants because it's full of numbers that the accountant would know, like the adjusted cost base and the UCC and that type of thing. One thing though that the agreement for purchase and sale needs to have in it is a price adjustment clause. A price adjustment clause. Because if, for example, on a transfer of $1 million item, it's a related party transaction, and CRA comes to audit 3 years later. And CRA says, you know what, our appraisers tell us that this thing's actually worth $1.1 million. And you therefore didn't take fair market value consideration because you only took $1 million. Therefore, remember that chart that I put up about section 69 a couple of weeks ago? One of those bad things is going to happen, like double taxation, probably. So the purpose of the price adjustment clause says, look, in the event that Canada Revenue Agency assesses us on a fair market value for the transaction, for the items transferred and the consideration received therefore, different from what it says in this agreement, the parties agree to change the redemption value of the preferred shares accordingly. And normally what this is about is about the preferred shares. So, like, you know, if our tax value is down here, this is 0, this is our tax value. Let's say the tax value is 200. And we take out 200 of boot. As we should, that's good planning. It's almost impossible that CRA is going to say, no, the value was only like $175,000 and you took out $200,000 in boot. Therefore, whatever bad consequence comes from that, it's probably not going to happen. Probably what's going to happen is CRA is going to say, look, the total was somewhere in the range of 900,000 to, let's say, $1.1 million. Let's say they choose this number. Well, then all we do is we use the price adjustment clause to change the value of our preferreds from $800,000 to $900,000. CRA is likely quite okay with that. And in fact, they will, when they do come to audit, and they almost always do, they will want to know if there is in fact a price adjustment clause. And in fact, on the prescribed form where the parties sign off on the election, the transferor and the transferee company, there's actually a box to tick as to whether there's a price adjustment clause in respect of this transaction. Such clause would be in the agreement for purchase and sale. Any questions on that? So that's purely lawyer stuff. Accountants have no competence in that area. It's for the lawyers to create that clause and honestly to remember to do it.
I have a question. Is it just value that changes? Because if you're issuing 1 million shares at $1 per or whatever, doesn't having a price adjustment clause change the value if there's other shareholders that are affected by that? And do they have to take that into consideration as well?
That's the chips fall where they may.
Right?
You had,
it's a $2 million company and you're selling half of it. Well, the difference between owning half a company and 60% of a company or 55% of a company could have actual impact, right?
quite right. So what that means, I guess, is that the parties to the transaction goofed, and they should have taken out 60% of the shares or 45% of the shares in the first place. And maybe the price adjustment clause would say something to the effect of the parties agree that there will be no change in, for example, the voting powers of shareholders relative to one another. Because the lawyers are smart and have thought about every contingency. Any questions on sections 84, 84.1, or 85? Let us put them to work and talk a bit about holding companies. So in the example we just did, we set up a holding company for this shareholder. We did it for a tax reason, and we did it just before a whack of shares were going to get redeemed out of this company and cause her personal tax. And she said, no, let's have a holding company, and the holding company will take this deemed dividend, thus I don't have to pay any tax personally. And hopefully this company doesn't pay any tax on the deemed dividend because hopefully there's no RDTOH down here. So that's one use of a holding company, which is to defer tax otherwise payable by an individual shareholder on a share redemption, under which or of which she has no control of the timing of that share redemption. Here's another one. I'll keep the same diagram. Let's say that two shareholders and very profitable business down here. Good news story. And this shareholder has financial needs. And there's only one class of shares, which, by the way, is very common. It's actually more common to have only one class of shares issued than two in private companies. And this person says, look, I insist we need to take money to the company because I need money. And if we're paying dividends on my shares, we're also paying dividends on your shares. Oh, look, she has a holding company. Holding company can take that money, hopefully pay no tax on it, invest it here, and she takes money out sort of when needed, thus pays tax on that basis. Thus, when you have shareholders, be right with you, who have different needs for money or different wants to buy stuff, having holding companies allows them to pay tax kind of when they want to. This person is happy to pay the tax today because they're taking the money out in actual cash to buy groceries or a boat or whatever it is. This person says, no, I think I'd rather keep the money invested rather than pay tax on it personally. Holding company is the answer. How did the holding company happen? She used Section 85 in the first place to create it.
Can the holding company reinvest that dividend back into the original company for a net zero? Or do they still have to pay tax? Or do they still have to pay tax on that at some point?
So can the holding company in a second transaction put the money back into here? Yes. The first transaction, though, is receipt of a dividend, so whatever tax result falls from that, for example, Part 4 tax, still happens. There's no way to make the Part 4 tax go away just because the day after we stuck the money back in here. So that's the tax answer. Now the lawyer question, though, is, well, what is this, like more shares she's bought? Or has she loaned the money? Or how does she get compensated for the fact that she's invested more money into the company? So that's a question sort of between the shareholders, and legal counsel has to come up with some answers for that as well. Maybe she just says, look, the best I can earn here is sort of 8% in the stock market. Why don't I loan it down here at 12%? Other shareholder says, awesome, away we go. This company loans the money down here, 12% interest, fine. Because to your earlier point, if it comes in shares, now we've got maybe an upset as regards who knows what, voting and rights on dissolution, et cetera, et cetera. Show of hands, who's taking the Trust and Estates course now? Have you taken estate freezes yet? Estate freeze?
It's this tomorrow, we'll work on it.
No way. Well, let's talk about it today then. Tomorrow? Seriously? Awesome. I'm all excited. This is a big service opportunity for you to provide your clients. Someone started this company 20 years ago. One shareholder, let's say, keep it simple. Company has an adjusted cost base of $1,000. Company is now worth $20 million. I'm actually going to give you for this some real numbers from one of my clients. And there was more than one shareholder, but for sake of discussion, operating company, retail actually, $20 million. It is thought by the shareholder that the company will be worth more than $20 million someday. And the shareholder says, like, when I die, if the company is worth $30 million, when we die, we have a deemed disposition of all of our assets. With one exception, if we leave our assets to our spouse, there's a rollover. Rollover is like a Section 85 rollover. It's just no tax payable, and the spouse inherits, in this case, literally, the tax attributes of the assets, for example, the shares. Let's say the unthinkable happens, both spouses die, and now we have $30 million fair market value. This is 5 years later, and adjusted cost base of $1,000. There is a lot of tax to pay. There's a deemed disposition with a $29.999 million capital gain. Where do we get the money to pay the tax? Who knows? Might have to sell the company to generate money to pay the tax, or hopefully have life insurance or something else, some thing by which would actually provide cash. Because we can only pay cash with tax with cash. We can't pay tax with, well, take the shares. It's not a good day. So, thinking that the company will increase in value, the shares that this person owns are common shares. And common shares are the type of shares that increase in value. Preferred shares do not. So the person says, well, where can I get some preferred shares? How about, I'll use Section 85, and I'll transfer my shares of this company, which I'll call OpCo, to HoldCo. And I'll take back $20 million of preferred shares. $20 million preferred shares, elect at $1,000, so that's now the POC and adjusted cost base of my new preferred shares. And I will issue, or HoldCo will issue, to say my wife and my children, common shares, for $100. Let's say $100 a piece. And that's the fair market value of those shares, by the way. The fair market value of these shares is only zero or close to it. Because the only asset of this HoldCo is this $20 million worth of preferred shares. And all of the shares of HoldCo are held by this person. Thus, there's sort of no equity for anybody else, except these people who actually put in $100 each. Total of $400. So this is a fair market value transaction because this company, all of its value is represented in the preferred shares owned by this person. That's what makes it so easy for these folks to buy in now for only $100 a piece. Time goes on. Yes?
And those $100 shares are common shares from the
These,
local?
thank you very much. These $100 shares are common shares, thank you. That's an important part of the punchline here. These are common shares. What we have done is frozen this person's interest in this whole thing. This person used to have a common share interest in OpCo, which could someday be worth $30 million. This person said, you know what? I'm quite happy to only have 20 million. I think I can retire on 20 million or whatever someday. On the chance that the value of this whole thing of the OpCo increases higher than 20, when I die, I want to be possessed only of $20 million worth of shares, represented by preferred shares in Holdco, which replaced for that person the common shares he used to have in OpCo. So yeah, in fact, the person dies, let's say, and yeah, proceeds $20 million, adjusted cost base 1,000, capital gain, blah, blah, blah. That's better than 30 million. Yes, first and second.
Could Holdco hold the 20 million in common shares of OpCo and issue?
Yes, these are common shares.
And issue the taxpayer $1,000 worth of shares in Holdco?
Common shares?
Preferred shares, just because when,
Instead of 20?
instead of 20 million?
No, it's a section 69.
Okay, that's the thing, it's gotta be fair market.
Correct.
Alright. Does it have to, so does section 69 state specifically that it has to be preferred shares, or can he could do 1,000 preferred and then 1.9 or 19 million of common, and then when he dies,
He probably wants to do the opposite.
because he doesn't want to have to, because I mean, if it's a deemed disposition, he doesn't want to have to come up with the capital to pay, right? He has to come up with the cash to pay the gains, right?
Correct.
So how, if he's electing for $20 million of preferred shares here, where is he coming up with the money?
He either has to take out dividends at some point, or buy life insurance, or something like that.
Okay.
The money has to come from somewhere.
So that's why I was wondering whether or not there's a way to reduce that, to get less preferred, but you have more common shares that will be redeemable to cover the tax.
But the more common shares he has, the more he's undermining his objective, which is to freeze his value.
Okay.
If he takes a whack of common shares in this, then he is not freezing at 20, he's freezing at...
So the goal in this structure is not to come up with funds to pay the taxes.
No,
Okay.
that's a separate problem. That problem, frankly, his lawyer may not have any solution for. What the lawyer does is say, look, at least we can put a cap on your exposure for taxable capital gains at death. One,
So,
two.
this question's about that's a $20 million, they think that the OpCo's gonna grow. What happens if it doesn't grow, it falls into negative? No more, it's not worth 20 million anymore. By the time he dies, it's only 10 million. What happens in that case?
Sort of no harm. I mean, the preferred shares, therefore, are worth less than originally issued. There's sort of no tax problem occurring as
So
a
there's no
result.
tax.
There's only a, gosh darn it, my company's worth less than before, which is, again, something the lawyer can't necessarily help with.
So the only reason you want to do this is to preserve the legacy of your company, I suppose, like after you die, it seems like 30 million is...
No, the only reason to do this is to reduce the deemed proceeds at death.
Right.
The legacy of the company and who's going to carry it on and stuff like that, totally separate issue.
But you want 30 million, not 20 million.
Well, OpCo would still be worth 30 million, right? But it wouldn't be attributed to them.
I'm going to say something that you may not believe, which is that at some point most rich people say, you know what, if it's a choice between more money in my hands and being able to say that I'm worth 30 million versus capping my death taxes. I'd like to cap my death tax. I don't need to say that I'm worth 50 or 100 million dollars. I'm quite okay to just have 20 million. Yes,
Can this also be used in succession planning? Let's say the individual wants to retire from the business.
totally,
So you could take the $20 million, live off the dividends from the preferred shares.
precisely.
And the kids
Or
can-
redeem them over time or something like, that's exactly what happened here. Yes,
I might have missed this, but where did you get the $100 for the value of the shares you issued to like their family?
just a convenient number, give me $100 a piece for the shares.
Oh,
Give Holdco $100 a piece for the shares.
sure.
Punchline, this company is now worth $500 million. $500 million.
Let's focus, so their family members don't kick the bucket, or else they're gonna end up,
Correct.
right?
Again, something that-
Because that's what you're doing essentially, right? You're capping the shareholder we're talking about at 20 million by offloading that gains risk onto the family members.
Totally right. So it's called two things. It's called an estate freeze, because we've frozen the value of this person's estate. It's also called generation skipping, which means instead of this generation being taxable, we're going to make this generation taxable. This generation says, okay, well, I've obviously got this problem to think about, but I do have a company that's worth $380 million. So I think I can sort that out before I die, and these people are only in their 20s.
Why can't I have those problems?
And yeah. Oh, did I say 380? I meant 480 million. Yeah. So I'll let that sink in. And again, my client says, yeah, 20 million, and this was over 20 years ago, when $20 million was a lot more money than $20 million is today, but quite fine. Yes.
Can you just keep doing this to continue putting off your tax burden?
Can you keep doing this? Can you put off the tax burden? Yes. Except that over here now, you can't put it off for this person. But these people can. Let's say they do an estate freeze. But now their estate freeze is at today's value, which is $480 million. Now, if they're thinking the company's worth $1 billion someday, that might be a smart move. So they can do the same and skip a generation with respect to the appreciation in value after today. But we can't do anything about the appreciation in value that has occurred up to today. We have to pay tax on that. All we can do is freeze. We can't reverse the clock. Any questions? Now, these are common shareholders. This is a preferred shareholder. He probably wants to outvote these folks. So in the issuance of these shares, we either issue shares that have like a zillion votes per share, preferred shares, or we make sure that we're issuing more shares than these people have, thus to outvote these people. So this person who founded the company, let's say, or whatever, still wants to have control. Control is separate from value. We've separated the value by having these be worth 20, and the control we maintain by having more shares, or each share having more votes than these common shares do. You okay so far? The usual thing that happens with these people, and in fact what happened in this situation, is that instead of issuing shares directly to these folks, a trust was settled. Good one. Of which these people are the beneficiaries. The same family members are the beneficiaries. Could be family members, it could be employees, sort of like whoever this person sort of wants to bring into the tent, are all beneficiaries of this trust, which owns these common shares. And in fact, this person can actually be a beneficiary as well. If later on the trustees decide that $20 million wasn't enough, this person can be distributed shares from the trust, common shares, that will provide this person with more than 20. So let's say preferred shares of 20 and another $5 million worth of preferred shares. This is a discretionary trust, which means that the distribution of whatever from here, like common shares, or the dividends thereon, or something like that, pardon me, is fully at the discretion of the trustees. It's not like it's a 1/6 or 1/n. It's some of these people might get shares someday and some might not. And again, these folks normally are family members, but could also be employees or anybody else that the sort of person in charge wants to benefit. And I hope that tomorrow's class is very interesting. In fact, I wish I could sit in. Any questions about this? Yes?
Is it beneficial to have a trust hold common shares to avoid having disruptions for dividends and things like that? If you're dealing with arms like party or non-arms like parties?
Yes. It's beneficial in that the trustees of the trust sort of make the decisions, rather than these people acting qua shareholder or I mean, some of them might also be directors of this company, and honestly, it's the directors that decide when dividends get paid and how much. But it's the trustees who decide, independent of when the dividends are paid, who and how much gets paid something out of the trust.
Because not in this example, but in the previous example where we had the two shareholders, one that needed cash now, if there was a holding trust in between, there could be a dividend issued, and it could be routed however they wanted, and then the other person just wouldn't see anything and wouldn't have any tax, right?
That's true, but in that case, both these people in the earlier example dealt at arm's length. And are you telling me that you're gonna, I'm saying as shareholder, you're saying you're gonna pay money out of my company into some trust and I don't get a piece of that? I at least want that to be sitting in my corporation, on this side, my corporation as it was in the diagram. The other thing is, unfortunately, a trust is a taxable entity, which a corporation is not. Thank you, 112 bracket 1 on dividends, unless part 4 applies. So if money goes into a trust, the trust says, oh my God, I gotta get rid of this money because I'm gonna pay tax on it. That's a different dynamic from having just money flow in nicely into my corporation and get reinvested with no tax having been paid. The children are two sons who are in their 20s. One has been to business school, the other not. They've got some business experience outside the company. Hopefully the answer is that one of them will take over as CEO one day. Meantime, they're getting mentoring and all that kind of stuff, which is great. We have 21 years to make this decision as to who gets what out of here. The trust only has 21 years. At the end of 21 years, the trust is deemed to have sold the property that it got 21 years ago, which could give rise to a capital gain up here, which would be disaster, because the capital gain would be based on this value of $500 million minus the 20. That would be a terrible situation. I actually don't know what the result was. The 21 years expired, I think, in 2018. The result, hopefully, is that the trust distributed common shares of this company out to these people in whatever proportion the trustees decided on. And the trustee's decision, the trustee is smart to consult with a lawyer because there could be issues like spouses, spendthrift beneficiaries, et cetera, beneficiaries who sort of need money and beneficiaries who want money, and so on and so on. So there's a lot of family dynamics and a lot of legal issues at play. As to, on the 21st birthday of the trust, who gets what out of here? Fascinating issues for which a lawyer can add huge value. And just to repeat, this is for family members, but also for employees. And the freezor, who is this person, can also be a beneficiary of this trust and thus be distributed common shares, therefore undoing part of that person's plan, because the person didn't want to have more than $20 million worth of possible capital gain exposure, but maybe at some point needs more money for something personal. The thing that gives us the freeze is the ability of this person to take preferred shares in this holdco, thus replacing the common shares that this person had in this opco. It is common shares that increase in value, not preferred shares. Thank you, and see you back here at 3:05.